Welcome to the video. Today we will challenge the habit of piling cash into high-yield savings accounts and show why excess cash can quietly work against your long-term wealth. We will build a clear rule set, protect your emergency fund, maximize tax-advantaged accounts, and then invest for growth with a sensible strategy you can automate. Here is our roadmap. First, we will explain how high-yield savings can become a liability after your emergency fund is set. Next, we will define a concrete safety net mandate. Then, we will prioritize tax efficiency across 401k and IRAs before funding a taxable brokerage. After that, we will weigh index funds against individual stock picking. Finally, we will show you how to act now with dollar cost averaging and give you a checklist and quick quizzes to lock in the learning. Let's start with the problem. Cash feels safe because its nominal value rarely moves. However, inflation steadily erodes purchasing power, so the dollars you keep idle today buy less tomorrow. High-yield savings accounts are excellent for liquidity and short-term needs, but their interest rates rarely outpace inflation over time. That gap translates to lost purchasing power and lost opportunity for compound growth. Consequently, after you secure your emergency fund, leaving large sums in savings can be a drag on long-term results. Therefore, our approach is to protect the cash you need and systematically deploy the rest into productive, tax-efficient assets. High-yield savings accounts shine for near-term needs. They are liquid and stable, which is exactly what you want for unexpected expenses or imminent purchases. However, their weakness is that interest often trails inflation, particularly after taxes. Over longer horizons, this creates a real loss in purchasing power. Here, there is also an opportunity cost. Money not invested in diversified markets misses potential compounding. The takeaway is simple. Use HYSA for your emergency fund and short-term goals. But once those are covered, channel surplus cash into a structured, long-term investment plan. Before we proceed, a quick but important disclaimer. This content is educational and not individualized financial, tax, or legal advice. Your personal circumstances, goals, time horizon, and risk tolerance matter. Consider speaking with a fiduciary financial advisor and a tax professional before acting. All investing carries risk, including the potential loss of principal. Any numbers, allocations, or diagrams shown are illustrative examples, not recommendations. First, define your safety net. Calculate your essential monthly expenses and multiply by 6 to 12 to form your emergency fund target. Next, automate contributions into your HYSA until you reach that target. Clearly label and segregate this account so you are not tempted to dip into it for non-emergencies. Once your emergency fund is fully funded, maintain it in cash for liquidity and peace of mind. Then, and only then, direct all surplus cash into your investment plan. Now prioritize tax efficiency. First, capture the full employer 401k match because it is effectively a guaranteed return. Then, consider maxing an IRA or Roth IRA depending on eligibility and tax strategy. After that, increase 401k contributions toward the annual maximum if cash flow allows. Only after optimizing these tax-advantaged accounts should you direct new dollars into a standard taxable brokerage account. This ordering aims to enhance after-tax returns and accelerate compounding. Let us compare index funds and individual stocks. Broad market index funds typically provide instant diversification across hundreds or thousands of companies at very low cost. They demand little time and, historically, have delivered attractive long-term results with lower volatility than concentrated positions. In contrast, individual stock picking concentrates risk in fewer names, requires significant research, and exposes you to sharper price swings. While some investors achieve impressive gains, many struggle to consistently outperform after costs and taxes. For most long-term investors, low-cost index funds are the pragmatic default. This mind map organizes your plan. At the center is investing. One branch is the emergency fund held in a high-yield savings account with a 6 to 12-month target. Another branch is tax-advantaged, prioritizing the employer 401k match, then IRA or Roth IRA, followed by increasing 401k contributions. The next branch is the taxable brokerage, emphasizing broad market index funds and ETFs, with optional small satellite positions if desired. Finally, the rules branch captures your operating system, dollar cost averaging, periodic rebalancing, and diversification. Any percentage allocations here are strictly examples and must be tailored to individual risk tolerance. Use this checklist to sequence your dollars. Step 1 is your emergency fund in a high-yield savings account, targeting 6 to 12 months of essential expenses. Step 2 is capturing your full employer match in the 401k to avoid leaving free compensation on the table. Step 3 is maximizing an IRA or Roth IRA for tax-advantaged growth. Step 4 is increasing 401k contributions beyond the match, ideally moving toward the annual maximum as budget allows. Step 5 is funding a taxable brokerage account and automating dollar-cost averaging into broad index funds. This order balances safety, tax efficiency, and growth. With your safety net and account order set, act now using dollar-cost averaging. Automate a fixed contribution on each payday into your chosen index funds. Avoid market timing. Staying invested and consistent typically matters more than picking perfect entry points. Review your plan annually and rebalance if your allocations drift away from targets. When income rises or expenses fall, increase your DCA amount to accelerate progress. This systematic approach reduces decision fatigue and keeps your money compounding. Quiz time. Question: how much should you keep as an emergency fund before investing surplus cash? Option A, 1 to 2 months of expenses. Option B, 6 to 12 months of expenses. Option C, a flat $1,000. Option D, you do not need an emergency fund. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 6 to 12 months of expenses. This range balances readiness for emergencies with the need to get excess cash invested. It keeps you liquid and calm during disruptions, while allowing surplus dollars to pursue growth. Second quiz. Question: what should you generally prioritize right after securing your emergency fund? Option A, capture the full employer 401k match and aim to maximize tax-advantaged accounts. Option B, open a taxable brokerage first. Option C, put everything into speculative assets. Option D, leave all cash in high-yield savings forever. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to capture the full employer 401k match and aim to maximize tax-advantaged accounts. This order improves after-tax returns and leverages benefits you cannot replicate in a taxable account. Only after these are optimized should you direct ongoing surplus to a taxable brokerage. Let us lock in the key takeaways. Use a high-yield savings account to hold your emergency fund and short-term goals. Define your emergency fund as 6 to 12 months of essential expenses. Prioritize tax efficiency by capturing your employer 401k match, then maxing IRA contributions, then increasing 401k contributions toward the annual limit before funding taxable accounts. Favor low-cost, broad market index funds as the core of your plan. Finally, automate dollar-cost averaging and stay disciplined through market fluctuations. To summarize, first, secure your emergency fund and keep it in a high-yield savings account. Next, optimize tax-advantaged accounts by grabbing your 401k match and maximizing IRA contributions, then increase 401k contributions. Invest surplus cash in a diversified index fund portfolio, automate your contributions through dollar-cost averaging, and rebalance periodically. Review your plan annually and adjust as income, goals, or risk tolerance change. With these steps, your cash stops gathering dust and starts compounding. Thanks for watching. If you found this useful, please like the video, share it with someone who is hoarding too much cash, and subscribe for more smart money moves. Drop your questions or your current funding order in the comments. What will you automate first this week?